Hi, it's Geoff here. Let's take a look at the difference between tax avoidance and tax evasion. Now, tax avoidance refers to people and corporations legally using a country's tax laws to minimise how much they have to pay in tax. We call that a tax liability. And basically it involves restructuring or reorganising your financial affairs in a way that lowers the amount of tax that you owe and have to pay. Tax avoidance is legal. It's often criticised for being unethical. Some examples: multinational corporations and their use of transfer pricing. So the likes of Google and Apple and Amazon have been accused in the past of shifting profits to low tax countries or low tax jurisdictions such as Ireland to reduce their overall corporate tax burden. Many people use offshore tax havens where wealthy net wealth individuals, businesses use the likes of the Cayman Islands, Bermuda, Switzerland to legally park financial assets in low tax areas. And businesses often will, rightly, many ways, take advantage of research and development tax credits or 100% investment allowances or depreciation deductions to lower their taxable income. Oftentimes the government does provide tax allowances and tax credits as a way of incentivising behaviour. Now that leads to tax avoidance. It's part of the policy mix, and that is legal. Whereas tax evasion is the illegal act of deliberately avoiding paying tax through misrepresentation, fraud, or hiding your income and your wealth and your assets. It's illegal and it is punishable by law, although often hard to prove. So people might hide their income in offshore accounts. The Panama Papers, nearly 10 years ago now, revealed how politicians, celebrities and businesses concealed their wealth to evade taxes. Oftentimes, small businesses might not report cash transactions to avoid paying income tax and VAT, so the underreporting of income. And people might submit fake expenses and fraudulent claims to deduct how much tax they have to pay. Well, the scale of tax avoidance and evasion is, of course, a major economic as well as a political issue. In terms of avoidance, it's hard to measure, of course, but the OECD, which represents about 26 leading advanced countries, they estimate that corporate tax avoidance through profit shifting and transfer pricing cost governments somewhere between 100 and 240 billion pounds annually. The IMF estimates that transnational corporations shift up to $1 trillion worth of profits annually to low tax jurisdictions. That doesn't mean they don't pay any tax, but they're paying less tax than if those profits were elsewhere. Tax evasion, according to the Tax Justice Network, which is probably one of the leading investigative agencies on this issue, this was before the pandemic. They estimated over $400 billion lost in tax revenue annually. And the shadow economy, which is linked to tax evasion, can be very high. It can be high in developed countries as well, but often undeclared work, hidden incomes, can be a sizable percentage of GDP. The Parliamentary Accounts Committee published a report just last week on the UK, and they estimated that tax evasion costs over £5 billion a year in the UK in lost revenue, 4/5 of which could be attributed to small businesses. And here's the latest Tax Justice Network report, 2024, suggesting that the Virgin Islands, British Virgin Islands, Cayman Islands, Bermuda are amongst those with the highest index for the scale of tax evasion. They estimated that on average, higher income countries lose taxes worth around 7% of how much they spend on their health service. But for lower income countries, that tax loss is 5 times bigger. It accounts for over 1/3 of the money spent on the public health budget. So clearly tackling tax avoidance and tax evasion can bring significant fiscal dividends to countries that do this successfully.